Hey everybody, welcome on in. SmartHelping.com here. I'm Jay, and we've got a short-term rental arbitrage model here, also known as the Airbnb Arbitrage model. It was a request from a viewer on the live stream. No, I do live stream every morning at 10 a.m. Eastern, Monday through Friday, and subscribe, like the video. Okay, so what we got here is a nice little tool. It's pretty simple. Anybody can use it. Um, the basic model is, well, what is arbitrage? It's not technically like risk-free arbitrage, but what we're doing here is saying activities where you lease a property and then you sublet that out to short-term rental sites, like Airbnb or VRBO or those other sites where people can book with you. The whole reason is the idea is that you can make more through those short-term rentals per month than what you pay on the lease of the property. So we got all kinds of cool cost and revenue assumptions, a lot of nice logic here. The model will allow for up to 100 properties to be modeled out, up to 100, individually set with different room rates, different leases, all this other stuff. This is just a dashboard here where you can define the launch year, what month you want to end the forecast. It can go up to 10 years by month. You'll see monthly and annual summaries. Also, you can assume that in the first X amount of months of each property's life or age, the percentage discount you want to give on the base rate. Now, why is this here? Is some people like to reduce the price to get some good reviews right at the beginning. If you're not going to do this, that's fine. You just do a 0% discount rate here. And you can see this discount rate dramatically will affect the numbers here. You'll see, watch when I change it from 25% to 0. Watch these distributions. So they're at 580 and 313. If I go 0 here, 650, 350. So pretty big changes. On this, pretty big changes in look at the total ROI. You're at 1200 and 2800% over the life of the model at a 25% discount for the first 3 months, down to 578, 1360. So this had a major impact. Um, and these are just returns for the IRR of the full project. This is on a monthly basis. These IRRs are on an annual basis. The monthly is more accurate. Uh, Average margin on booking. So this is what your average making on against the lease versus what your booking revenue is. For example, if I book it out for $100 a month, and let's say my lease is $70 a month, that makes you $30 in profit a month. Or let's say in this case, it actually be what, not 70, it'd be 78. Yeah, 22% and then 22% of 100. So that'd be like having a revenue of 100 and your expenses of $78 for a lease. So that's what that percentage shows across the entire portfolio of all the properties. Total upfront costs, uh, total operating income produced over the period, any property count, and then if you want a joint venture, you can assume any of the costs related to doing this, which would be mainly startup costs and any burn at the beginning. You can fund with some investor money or operator money or both or just operator. If it's no investors and just you can do 0% here and here. So pretty nice functionality. Now let's get into it. So the cost assumptions lets you define the start month of every property. This is the month you're signing the lease and the monthly lease cost is happening. Okay. You can define a dynamic start month for all 100 properties. Over here, you can see this. You define the property ID. These are unique IDs. The name of the property, so you can keep organized. The monthly expected growth in lease cost here. Also, if you're going to be doing short-term rentals, you're probably going to have some cleaning costs. You're probably going to have some other fixed random costs here that you have to account for. So you can apply these here. Now the cleaning and other costs put in this row are variable and they will change based on your revenue assumption daily rate variance. So this is just a percentage essentially accounting for busyness. So when you're assuming you're going to be busier and charging higher rates, you're likely to also have higher cleaning costs. And when it's lower, you're probably having lower cleaning costs. So this is the base rate that will adjust based on this percentage here. up or down from 100%. Now 100% would be the base rate. Fixed cost, doesn't change. It's just $50 a month per property, and you could change. Now you can change each of these property amounts. So each of these properties might have different lease amounts, different costs you think you'll have. And then finally, you also have some one-time costs. They're not much, like I said, it's just your leasing. So you might have an application fee, possibly a deposit, maybe some insurance, maybe some other legal fees, maybe some furnishing. Now, this could get expensive if you're going to put in like, I don't know, you have to check with the landlord if you can do a hot tub or maybe a pool table or um, just different things to make the property more attractive. So those costs you can put in all here, and that will flow through to the cash flow dynamically for each property. You've also got revenue assumptions here, so we can define the base daily rate we're going to charge for the property dynamically for all 100 properties. You can define the percentage variance from that base in month 1 through 12 of the season, and this is for seasonality, and this will apply to each of the relevant month over the 10-year forecast based on the month it is. You can also apply occupancy. So this is a huge one. And it's just saying, if this is 50%, it's saying that out of a 30-day month, 15 of the days you are booked and 15 of the days you are not. So this is also going to affect revenue, and you can adjust that on each month of the year, and that will apply through to the full model. You can also define what you think you're going to raise your base rental rates at per year, so annual rate growth. Then we have startup costs. So these would be like any initial cost before you get started, like maybe buying this model, paying me to upgrade it, or whatever, just all kinds of different costs that might exist here. And these are just one time that happen before anything else starts. So you can define that here. We've got some visuals. You can see the monthly cash flow and the seasonality of the model here. Really nicely. You can see when we start making some nice profits. The monthly cash flow, this is accumulation of all the cash generated over time. Monthly lease payments. So as you add properties, your lease payment's going to start to rise. So this shows what your monthly lease cost is over time, and then your total cumulative property count. Now, if we go on the monthly summaries, where you can see all these assumptions driving through on a monthly basis for in aggregate across all properties. So you can see property count here, the total booking revenue. Now I've done a lot of math and a lot of complex logic to come up with these numbers. It's in this matrix tab here. You can see all of these things per property are done dynamically, and then that's aggregated over to this monthly detail. So you've got booking revenue, you've got lease expense on all properties, the gross profit on that. You've also got your fixed and variable costs per month. You've got your net operating income. You've got any initial costs when you sign the lease. You've got one-time costs and then total cash flow of the whole project here. Now, this minimum cash investment required is just taking the minimum cumulative cash flow, the smallest number on this timeline of these. And what that says is this is just enough cash to keep you above zero cash position over the life of the model. Annual summary is the same deal as a monthly, but on an annual basis. You can see, booking revenue, lease expense, what you're generating in profit, total other costs, and your actual cash flow. Now, the joint venture waterfall, this is based on those percentage contributions here on the front, and you've got the project level here, and the internal rate of return, discounted cash flow analysis, net present value, and then you've got the investor group here, their contribution and resulting distributions, and the owner operator contribution and their distributions. And this is the distribution rate. This is the IRR of each on an annual basis. And again, discounted cash flow analysis and net present value for each of those. And also a chart to show the investor versus the operator cash flows. Now, note the investor is going to be putting up most of the money, and the operator was going to be doing most of the work, and they might also put up some money. All right, that's the model. It's really cool. I think a lot of people could play with this and really get a handle on trying this out, maybe with a couple of properties at first. And if you want to purchase it, there's links in the description box below. Also posted to some vendor sites. It's just going to be a $45 one-time fee, and you can use this forever. Alrighty, and I'll see you on the next one.